Short pause. So, you've probably heard the terms partnership and joint venture thrown around, maybe even used them yourself. But did you know that in the world of Canadian tax, they are worlds apart? And that difference, well, it can have some serious financial implications. In this explainer, we're going to pull back the curtain on the joint venture. We'll look at what it really is, how it's taxed, and why understanding it can make a huge difference to your bottom line.
All right, here's our game plan. First, we'll nail down the definition. Then we'll jump into the nitty-gritty, calculating income, moving assets around, and a really big one, the small business advantage. And to wrap it all up, we'll look at how to make the right call for your situation. Okay, let's dive right in. Section 1, defining the joint venture. And as you can see, it really is all about purpose.
So here it is, the official definition. Now, the key phrase that you really need to lock onto here is limited purpose. Think of a partnership as a marriage. It's an ongoing business relationship. A joint venture, that's more like teaming up to run a single marathon. It's a temporary alliance built for one specific project with a finish line in sight. And honestly, this single idea, this limited purpose, it's the master key that unlocks everything else we're going to talk about today.
So where do these things pop up in the real world? Well, they're everywhere once you know what to look for. Think about the construction industry, right? You might have two massive companies come together to build one single skyscraper. Or in the resource industry, maybe for a specific oil exploration project. Even in R&D, you might see a joint venture for one particular research project. Or in Hollywood, a studio and an investor might form a joint venture to finance just one movie. You see the pattern here, right? It's always that single, limited goal that binds them.
Okay, let's put them side by side. This really spells it out. The scope of a joint venture, a single project. A partnership, an ongoing business. But look at that second line, entity status. This is huge. A partnership is a formal, separate thing in the eyes of the taxman when it comes to calculating income. A joint venture? It's more of an informal agreement. And trust me, that distinction isn't just for the academics. It has some massive real-world consequences for your taxes.
And that idea of entity status leads us perfectly into our next section, calculating income, because it all comes down to a key difference in control. So, this gets to the heart of the matter. Imagine you're part of a business venture. When it's time to file taxes and make those big decisions about deductions that can save you a lot of money, who's in the driver's seat? Is it a group decision where everyone has to go along, or do you get to decide what's best for you individually?
And we're not talking about small stuff here. We're talking about major discretionary deductions, things like capital cost allowance or CCA. That's basically the tax version of depreciation on your equipment. Or setting aside reserves for debts you think might go bad. You even have choices in how you value your inventory. These aren't just line items. The power to decide when and how much to deduct is a fundamental part of smart tax planning.
And this table just lays it all out. Look at the partnership column. The partnership entity itself makes one single decision for everybody. Let's say the partnership decides to claim the maximum possible CCA this year. Well, guess what? Every single partner is stuck with that decision, even if it pushes them into a bad tax spot. But now look at the joint venture side. Each member decides for themselves. You can look at your own unique financial situation and say, you know what, I'm going to claim less CCA this year. That level of control, that flexibility, it's a game changer. Okay, but there's always a catch, right? With all this great flexibility comes a bit of an administrative headache. Since a joint venture isn't its own separate entity, it doesn't have its own fiscal year end. So what happens if you have one partner whose year ends December 31st and another whose year ends June 30th? It means you have to crunch the numbers and figure out the venture's income for each participant's specific year end. It's definitely doable, but it's something you have to plan for. All right, next up, Section 3. Let's talk about moving assets, equipment, property, into and out of the business. And you're going to see a familiar theme here, simplicity versus complexity. This is a big one. If you contribute, say, a piece of equipment to a partnership, the tax rules can be tricky. Often, it's treated as if you sold it at its current market value. This is called a deemed disposition, and it can land you with a completely unexpected tax bill right out of the gate. Now look at the joint venture. It's just an informal pooling of assets. There's no sale, no deemed disposition. You can bring assets in, and you can take them out when the project's done, without triggering all these complex tax events. It makes getting started and getting out so much cleaner. Okay, let's get to what is, for many, the number one reason to consider a joint venture.
This is a massive financial advantage, especially if you're an incorporated business. It all revolves around this, the $500,000 question. So, what's so special about this number? Well, in Canada, certain private corporations, we call them CCPCs, get a fantastic tax break. Essentially, they get to pay a much lower tax rate on their first $500,000 of business income every year. It's called the Small Business Deduction, or SBD, and making sure you can use as much of that deduction as possible, that's absolutely critical. Okay, let's run the numbers with a quick scenario. Imagine a business with two equal partners earns $900,000 in profit. Your corporation's share is 50%, so that's $450,000 for you. Now, since that's less than the $500,000 limit, you should be able to get that sweet low tax rate on all of it, right? Well, not so fast. It all depends on the structure. And boom, here's the punchline. In a partnership, that $500,000 limit has to be shared among the partners. So with your 50% interest, you only get to use 50% of the limit. That's just $250,000. This means the other $200,000 of your profit is suddenly getting taxed at the much higher general corporate rate. Ouch. But in a joint venture, the limit isn't shared. Each corporation brings its own full $500,000 limit to the project. So in our example, your company can claim the low rate on its entire $450,000 share. I mean, the difference in the actual tax you pay is just staggering. Now, just a really important note here. This incredible advantage with the small business deduction is specifically for members that are Canadian-controlled private corporations, or CCPCs, so keep that specific qualifier in mind. Okay, so let's bring it all home. Section 5, making the right choice. We've seen some pretty compelling reasons to use a joint venture, but it's not a silver bullet. It really boils down to this one core trade-off, flexibility versus limitation. So let's just quickly recap the key points. On one hand, a joint venture gives you incredible tax flexibility, and it makes it way easier to create and wind down a project. But, and this is the most important but of the whole day, you can only use it for projects with that limited purpose and duration we talked about at the very beginning. You can't just slap the joint venture label on an ongoing business to try and get the tax perks. If the Canada Revenue Agency looks at it and decides it's really a partnership in disguise, well, that can lead to some very unpleasant tax bills and penalties. So I'll leave you with this question to think about. As you look at your next project, your next collaboration, you have to ask yourself, does this project truly fit that narrow, limited purpose definition? And if it does, is all that tax flexibility we've talked about worth it? Is it the right strategic move for you? As with so much in tax, the answer is always in the details.